So with most of the stock market gains concentrated in four of the biggest names in tech, what are the risks and should investors be concerned? Joining us now to discuss this is Erin Gibbs. She's a portfolio manager at S&P Global Market Intelligence. Welcome. Nice to have you here, Erin.
Thank you.
So are you concerned about this top-heavy market or not?
So I am concerned that they are concentrated in really what we consider two different sectors. I know you call them technology, but when you actually look at them, two of the top five are in pure technology, Microsoft and Apple, and the other two are communications. So the Facebook, the Googles, and then the last one, Amazon, is actually consumer discretionary. Remember, it's all about buying stuff. It's not a tech company. But even so, those are very concentrated, and that is somewhat unusual that we have so few sectors representative. When you look at the overall weightings and you say, oh, these top five, these top four stocks are such a big weight of the index, it's actually not that different from the past 20 years. And it has been a bit of a gradual increase over the past 5 years. Right. But when you look back 20 years, it's actually very much in line and much like what we kind of saw the average weights in the early aughts. So I'm not as concerned about them being big and having these mega cap stocks. I am concerned that investors are too focused in very much more volatile sectors, and they may not be getting the diversification that they really need.
I mean, if there is a concentration you're concerned about, it's that all five could be considered growth stocks, right? You don't have a value stock per se in this group, right?
Exactly. And all you have to do is just go down to sort of the top 10 stocks and you start getting some value stocks and some financials. But that's another problem, is that you are very much in these growth stocks, and growth stocks are the ones that have by far the highest prices, and not just higher than value. Even historically, when you're looking at the past 10 to 15 years, growth stocks are priced at about 50% higher for every dollar that they earn versus what a dollar of value stock earns. So you're paying 50% more for every dollar that they earn. And so that's concerning that you're paying so much more for growth stocks versus a value. And it is something that we definitely want to recommend to investors to be diversified and have some value as well as growth in your portfolio.
I was just going to ask you if the average investor should take a look at that and maybe say, you know, I need to diversify in some other sectors.
Certainly, if you have all of these though growth stocks have been doing well, and it is healthy to have an overweight in growth stocks when the economy is growing so well, but we're actually expecting a bit of a slowdown over the next 12 months, and particularly when we're seeing this increased volatility over the past 12 months, where you see these big, huge up days and down days, concerns about Chinese tariff wars, whether we're going to have a rate cut. There's some big unknowns out there. And so a little diversification at this point in the economic cycle is not a bad thing.
On that note, Erin, thanks so much for joining us. Erin Gibbs with S&P Global Market Intelligence.